Okay, dear students, welcome to all of you in FR December 2025 pre-scene mock. And I'm Abil Ahmed, CEO and Principal of Abil School of Accountancy. Highest marks in FR so far, one of my students, she took, they are 92. In fact, this event happened twice. After that, 90 marks, and let's see. And plus, if I just give you a little overview about my FM, I have produced, Alhamdulillah, world top in FM, world top in AFM, in ATX. We got highest so far 91 marks. In SBR, we got 3-time positions in Pakistan, Alhamdulillah. In ATX, more than 7-time positions. So almost in every paper, we have produced position holders. In taxation, highest marks, one of my students, she took 99 marks. In PM, highest marks are 85. So just thank God. Let's start. Pre-scene mock, FR, December 2025. I'm very excited to discuss this pre-scene mock with you. Let's start. So, what is the carrying amount of the building following the recognition of an impairment loss? After impairment loss, you need to calculate the carrying amount of building. Okay. A cash generating unit, we know the meaning of cash generating unit under IAS 36. Cash generating unit is the smallest identifiable group of assets which cash inflows are largely independent from other cash generating units. A cash generating unit has the following carrying amount in Blue Company's financial statements at 30th June X7 before allocating of impairment loss. In cash generating unit, if there is any specifically mentioned asset, first we provide impairment loss to that asset, after that goodwill, and then all other assets on pro rata basis. If there's no specifically mentioned asset, then obviously number one is going to be goodwill, and number two, all other assets, they fall in the scope of IAS 36 on pro rata basis. We have goodwill, plant, building, intangible asset. Logically, we do have non net current assets, but net current asset, they do not fall in the scope of IAS 36. Under IAS 36, we cannot allocate impairment loss to the current assets. The cash generating unit is found to be impaired by examiner has directly given us the impairment loss which we need to recognize is 1.13 million. On this date, the plant had a fair value less cost to sell of the disposal 1 million. Look at this. Carrying amount of the plant is 950, but the fair value minus cost to sell is more than 950. So logically, we cannot allocate impairment loss to the plant. Why? According to IAS 36, the objective is assets carrying amount should not be more than the recoverable amount. In case of plant, the carrying amount is lower than the recoverable amount. That is why we cannot allocate any impairment loss to the plant, even though the plant does fall in the scope of IAS 36. Why we can't allocate any impairment loss to the plant? Because carrying amount of plant is less than the recoverable amount. Okay, fine. So logically, first we have to provide impairment loss to goodwill. After that, we can just remaining impairment loss will be allocated to the building and intangible asset on pro rata basis. So the impairment loss is 1. I'm just ignoring 3 zeros. It is 1130. Let's allocate this to goodwill, which is 550. So how much is the remaining loss? Logically, the remaining impairment loss is 580, and this remaining impairment loss will be allocated to building and intangible asset. So basically, we are after building. The carrying amount of the building is 1300. Building plus intangible asset becomes 1700 into impairment loss which we need to allocate to the building is 580. This is you will get the amount of impairment loss which you can allocate to the building. 1300 divided by 1700 multiplied by 580. So I'm getting the amount of impairment loss which I can allocate is 443.529. Building value is 1300. If I deduct this, I'll get the carrying amount of building after impairment loss. So 1300 minus 443.529, I'm getting 856.471. Don't forget one thing, we have ignored three zeros. So this is part B. Don't forget, while solving the question, I've ignored three zeros, but in the multiple choice questions, of course, examiner has not ignored three zeros. So your answer for question 1 is B. That's simply nice. I like this question. This question was from IAS 36. Which of the following should not be recognized in the financial statement of an entity in the manner described? The IASB conceptual framework for financial reporting defines recognition as the process of incorporating within the financial statement an item which meets the definition of an element and satisfied what? Certain criteria. Element means there has to be asset, liability, it has to be at least one of them, asset, liabilities, income, equity expense. Plus it meets the criteria, then we will recognize, otherwise we will not recognize. Examiner is asking us which of the following elements should not be recognized as a liability. A provision for operating losses expected in next 12 months. You cannot recognize this as a liability. Straightforward, this is your answer. And this is what you study in IAS 37 many times. It is categorically written in IAS 37 that you cannot recognize provision for the future operating losses. In fact, if your company is so sure, if your company is so certain that in the future your company will face future operating losses, then take it as an indicator of impairment loss. But you cannot recognize the provision for future operating losses. I'm more than 100% sure there's no need to read any other choice. The answer is A. Great. Obviously, we will not be wasting time. Just a minute. How should brake company account for the change in use of land on July X4? Read it again. Let's read the requirement again. How should brake company account for the change in use of land on July X4? Let's read. Brake company owns land that was purchased on January X2 for 2 million. The company initially held the land for capital appreciation. You must think now, you should be thinking IAS 40. This one line is good enough for us to think for IAS 40. Land held for capital appreciation. IAS 40, investment property. So they are using investment property, fine. On 1st July X4, brake company occupied the land and began construction for its new head office. Stop. Basically, from IAS 40, now they are going towards IAS 16. There's a, I would say, conversion from IAS 40 to IAS 16. At the date of fair value, the land was 2.5 million. At that date, the fair value of the land was 2.5 million. Now stop. Initially, the carrying amount was 2 million. At the time of transfer, from 40 to 16, the fair value is 2.5. So first, you have to bring your investment property from 2 to 2.5 million. So the double entry will be simply investment property will be debited by 0.5 million. Then P&L, profit and loss, will be credited by 0.5 million, and that according to IFRS 18 you have to show under investing category. So logically at the time of transfer, the double entry will be investment property debited by 0.5 million and gain on investment property P&L will be credited by 0.5. But under investing category, why I'm mentioning investment category, I'm giving you the reference of IFRS 18 because in my regular classes I said many times whatever item normally now comes in P&L, normally you have to mention the category also. Either that goes to operating category, investing category, financing categories. Rest of the two categories are very easy. One is discontinued operation and another is income taxes. To me, The most important categories are operating, investing, and financing. So this 0.4 belongs to investing. Brake company uses cost model to measure its owner occupied building in accordance with IE 16, property, plant and equipment, and fair value to measure investment property. Let's see. Transfer the land from investment to property, plant and equipment. Fine. Recognize a gain of 0.5 million in investing category in the statement of P&L. Perfect. No need to read any other choice at all. So obviously there's a transfer. With the transfer, there's a gain as well. Wow, 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 wow. So far, examiner is nice towards us, I believe. Question 4. What is the total, look at the requirement, total expense to be recognized in the statement of P&L in the year ended December X4? What is the total expense? And the year end is December X4. On 1st January X4, Ponder Company entered into lease agreement to lease an item of machinery for how many years? 4 years. With rentals 250 payable annually. Starting on 31st December X4, so they are paying rental at the end of each year. Asset useful life is 5 years. At the end of the lease term, legal ownership will pass to Ponder. Now stop. Lease term is 4 years. Asset useful life is 5 years. According to IFRS 16, leases. If at the end of the lease term, if at the end of the lease term, ownership title is transferred to the lessee, then asset will be depreciated over the useful life of the asset. If ownership will not transfer to the lessee, in that case, right of use asset will be depreciated at the lower of lease term and useful life. Here, it is categorically mentioned in the question that ownership will be transferred to the lessee, so we will be depreciating right of use asset over its useful life, which is 5 years. Present value of the lease payment at inception was 7,50,000. Implicit interest rate is 12.2%. If implicit interest rate is not known to the lessee, then we use incremental borrowing rate. But here, obviously, we'll be using implicit rate. Logically, the double entry for 7,50,000 is right of use asset debit by 7,50,000. Lease obligation will be credited by 750. We will depreciate 7,50,000 over 5 years. Calculate. I love this question. See, so far it is very 1,50,000. The depreciation expense is 150. DAP is 150. Just a minute. DAP is 150. Wow. Now, we are not paying rental in advance. If we pay rental in advance, then first rental does not have the impact of interest. But we are paying the rental at the end of the year. So which means that December X4, you will have the finance cost as well. 750, which is my lease obligation, 12.2%, which is implicit interest rate. That will give us a finance cost. Wow, wow, wow. The amount of the finance cost is student 91,500. So to the P&L, lessee will charge the depreciation expense 150, finance cost 91,500 in the year ended X4. Let's add both of them. 1,50,000 depreciation expense, 91,500 finance cost. The total gives us 2,41,500. So logically, the lessee will charge to the P&L 2,41,500. I love it. Yeah. Exam. I wish in exam we should have the same type of questions. So far, oh no, something went wrong. It happens when you have too much excitement. Oh my God. I hope rest is okay. Let's see. Oh, this was the problem. Now what to do? Let me pause the video and correct this alignment. Okay. Let's deal with question number 5. What amount should be recognized in OCI, other comprehensive income, in relation to these shares in the year ended December X4? Again, company purchased 10,000 shares on 1st September X4. Making the election to measure them fair value through OCI, we know that in order to get OCI category, you have to make an irrevocable elections. Once you have made the irrevocable election, then whatever the change in the fair value comes, that goes to OCI. And under fair value through OCI category, transaction cost will be capitalized. It is only the P&L category where we expense out the transaction cost. In case of OCI category, we capitalize the transaction cost. IFRS 9 financial instrument, the shares cost 7.65, 10,000 multiplied by 7.65. Transaction cost with the purchase was 1,500. So initially, your investment value is 10,000 multiplied by 7.65 plus 1,500. The student initially investment fair value is 78,000. Transaction cost is capitalized. So initially it is fair value plus transaction cost. At the year end, share value is 8.5. 10,000 into 8.5 will give us 85,000. Wow, wow, wow. So we can see there's a gain of 7,000 in our investment, which will go to OCI. So far I can say that examiner is, I would say, is very nice towards us. Thank you. Thank you, examiner. But it's not only one, it's a whole examination team. So we should be thankful to the whole examination team. Which two of the following criticism apply to current cost accounting during a period of inflation? It requires frequent revaluation of asset, which can be subjective and complex. True. Because period of inflation, you need frequently you have to revalue, otherwise values will not be, I would say, updated. It may reduce comparability between companies using different valuation methods. Again, true. It reflects prices of asset prevailing at the time of consumption. Come on, there's no such thing. It is less useful. Come on, come on. How can you say current value is less useful than historical cost? If you say if someone says point number D is okay, then that person is from a different planet. That person is not from this planet. Let's go for question 7. Wow, wow, wow. Which of the following is the correct accounting treatment on 1st April X7? On 1st April X7, Chimpe company delivered. Should have written a champion company. A champion company, a machine to a customer. Delivered. I should be thinking for IFRS 15, revenue from contracts with customer. I have delivered the machine. Okay. The machine was purchased 2,60,000. Fine. The customer had a right to return the machine. Now, this is something for a full refund at any time. Up to, included what? 30th June X7. This is the new customer. At 1st April X7, chimney company was unsure whether they were likely to return the machine. They have no idea at all. You have delivered the machine. Price is 260, but your customer can refund you. Okay, so logically, you are not supposed to recognize the revenue in day one. It's not your revenue. Come on. B does not make sense at all. Receivable logically debit, but you have to credit the refund liability as well. C, you have to show the refund liability because your customer has the right to refund. So logically, the answer is Charlie. Wow. Question number 8. What is the carrying amount of land payable at December X3? Student, what is the carrying amount of land And payable December X3. Let's read the question. On 30th November X3, Vermizel company purchased land in another country at a cost 45 million euros. Okay. The land was classified as property, plant and equipment measured using cost model. At Vermizel company's year end, December X3, it had paid 36 million they have paid, but 9 million euros still owed. Exchange rates are here. What is the carrying amount? Now, student, please look at this. On 30 number X3, Vermizel company purchased land in another country. So you should be thinking for IS 21 should come in your mind. And of course, your functional currency is dollar. Now, some of the students, they just get confused that, sir, they have not mentioned that my local currency, my functional currency is dollar. How can you say that? I can say that. I did not make this paper. Just please use the common sense. You are buying the property, the land in another country. An examiner is giving you all the values in euros. An exchange rate is also given between euro and dollar. And look at your choices also. All four choices, examiner, they have given you in dollars. So now it is quite obvious. By using IAS 21, all you need is just translate them. And now let me tell you, land is a non-monetary asset, number one. Number two, it is categorically mentioned in the question. Company uses cost model for the land. So you will be simply translating the land only one time, which is at the date of acquisition. No more retranslation because company is using the cost model. When it comes to payable, payable is a monetary item. Payable is a monetary item, payable is a monetary liability. You need to retranslate on each SOFP date by using the closing rate. Okay, another thing, please, you should be able to read this, I would say, exchange rate as well. Exchange rate says logically 3 euros, they are equal to $1. 3 euro, they are equal to $1. So it is, you should little bit math, you should be little bit good at maths. If 3 euros are equal to $1, it means dollar, according to this ratio, dollar is stronger than euro. If dollar is stronger than euro, it means that whatever amount is written in the euro, when I'll be converting that amount into dollar, then amount in dollar will be less than the amount which is in euros. Why? Euro is weaker than the dollar. Otherwise, there's one more understanding. Whatever comes, basically one is always representing the denominator. So actually exchange rate sign is like this: euro upon dollar, that is foreign currency upon local currency, that is an indirect quote. Under indirect quote, while translating we always divide. Indirect quote, while translating we always divide. So simply 45 million divided by 3, the value of the land is 15 million. At the year end, only 9 million euro liabilities left. At the year end, only 9 million liabilities left. And this 9, number one, payable is a monetary liability. Second, we'll be using the closing rate to translate this 9 million. Closing rate is the exchange rate, which is on SOFP date. So I'll take this 9 million euros for the payable, and the rate on year end is December X is 2 million. So it comes 4.5 million. Average rate, we are not using it. Basically, average rate we use for P&L items. For monetary items, asset and liabilities, we retranslate them on each SOFP rate by using closing rate. So land should be 15. Payable should be at 4.5. Carrying amount of the land is 15. Payable is 4. Wow, wow, wow. I love this question, seriously. So far, again, I can say that your examination team is very nice towards you. But if you are not preparing, then it means you don't want to be nice for yourself. That is a separate story. What is the correct carrying amount of the factory? In Gemai's company's statement of financial position as at 31st October X6. This time they're asking the carrying amount of factory year end. Okay. On 1st November X5, Gemai's company held a factory with a carrying amount 10 million. Start of there 10 million. Measured using the cost model. The factory had a remaining useful life 10 years. The useful life is 10 years. Jamai's company intended to sell the factory as soon as major customer order was completed. Stop. First of all, whenever your examiner says we are about to sell the non-current asset, we want to sell non-current asset, first you should be thinking for IFRS 5. Non-current asset held for sale and discontinued operation. First you should think simply IFRS 5 should come in your mind, number one. Number two, before applying IFRS 5, you have to see the criteria of IFRS 5. You can only apply IFRS 5 when the criteria is met. If the criteria is not met, you cannot apply IFRS 5. Okay. So Gemini simply intended to sell the factory as soon as a major customer order was completed. This was expected to take at least a year. Gemai's company started marketing the property for sale on August X6 at a price of 14, which was the property fair value. Cost to sell was 0.5 at Gemai's year end X6. Customer order was still incomplete, but it was expected that it would be completed the next year. XYZ, blah, 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 blah. Student, now listen and listen carefully. According to IFRS 15, according to IFRS 5, there are a number of points in the criteria. One, your asset should be saleable in its present condition. Second, you should be quoting the reasonable price, which they are quoting. Another point is after applying IFRS 5, assets should be sold within 12 months. Your management should carry out the active program to locate the prospective buyer. Management should be committed to sell the asset, all and XYZ. But right now, what is happening here? Even one of the point is not met in the criteria, you cannot apply IFRS 5. Now it is, if you read, Jamai's company intended to sell the factory as soon as a major customer order was completed. Simply, your factory is not saleable in its present condition. You won't be able to sell it unless the major customer order was completed. So right now, IFRS 5 is not applicable. IFRS 5 is not applicable. Why IFRS 5 is not applicable? You are saying you do have the intention, but you are saying we will sell it when the customer order will be completed. So simply your asset is not saleable in its present condition. Even you cannot apply IFRS 5 when you are thinking. Even you cannot apply at the end of the year also IFRS 5 because customer order is still incomplete. So simply you are unable to meet IFRS 5 criteria. So forget IFRS 5, go for the normal accounting. Under normal accounting, the cost of the factory, the carrying amount of the factory is 10, remaining life is 10 years, so 10 divided by 10. The depreciation is 1. So simply I'll get the carrying amount 9 million by using normal accounting under IAS 16. I cannot apply IFRS 5 because we know that after applying IFRS 5, we cannot depreciate non-current asset held for sale. In fact, after applying IFRS 5, no more depreciation, plus your non-current asset will be reclassified to current asset. Third, asset will be measured at lower of carrying amount and fair value minus cost to sell, whichever is lower. But right now, IFRS 5 criteria is not met. So simply I'm using IAS 16. So 1 year depreciation I've deducted. So carrying amount logically should be 9 million. So we do have an option A. Again, consider this a good question. I think so far, how many IASs and IFRS examiner has tested? I believe there was 36. 16, 15, 5, 16. Wow, 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 wow. ISB framework also. Okay. Word gain on disposal. It is categorically mentioned you are supposed to calculate gain. Please don't calculate the loss. Word gain on disposal should expense company. Recognize in P&L in relation to sale and lease back of the building in the year ended 31st May X9 to one decimal place. Okay, okay, one decimal. And this is also important. You will be calculating that gain in millions. Okay. If nothing is mentioned, then you have to take the complete figures. Let's read. On June X8, expense company owned a building with a carrying amount as 21.6 million. On this date, E company sold the building to a finance company for 36 million. Its fair value and immediate, they sold it at fair value, thank God. And immediately entered into a agreement to lease it back for how many years? 20 years. So let me first calculate the carrying amount of right of use asset. Right of use asset. We'll take lease obligation, simply present value of minimum lease payment. Fair value of asset sold and carrying amount of asset sold. The remaining useful life of the building was 25 years. The sale and leaseback agreement required payment of 2 million payable annually in arrears at the end of each year. At June X8, present value future lease payment was 30. 30 divided by 36 into 21.6. Let me use the calculator. 30 divided by 36 into 21.6. Student, that gives me the answer 18 million. Debit and credit. Right of use asset 18. And let's say your property, plant and equipment carrying amount was 21.6. We sold it for 36. Bank. Lease obligation, they have given us 30. So it is categorically mentioned to calculate gain. So balancing figure gain on transfer. Gain on transfer. How will you calculate? Simply add the debit side minus the credit balancing figure, you will get gain on transfer. Let me use the calculator. 18 plus 36 gives me 54 minus 21.6 minus 30. Minus 30. Students, the gain amount I'm getting is 2.4 million. One, it is in million, second in one decimal. Wow, wow, wow. So far, I would say the entire examination team looks very, very, I would say, nice towards us. Let's go for question number 11. Wow. Which statement reflects correct accounting treatment in far field financial statement for the year ended December X6? Which statement reflects correct accounting treatment? Let's read. Farfield company has sold washing machines with a 1 year warranty, standard warranty. As part of its contract for sale for how many years? They are not selling just in 1 year. They will keep selling for how many years? 6 years. In the year ended December X5, it sold 1,25,000 machines. Wow, 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 wow. At the year end X6, they sold 1,35,000. Great. On average, 8% machines sold in a year need to be repaired under warranty. How many percentage? 8. At each reporting date, repairs department estimate the average cost per repair in the coming year. So at each year end, they actually revise their repair cost. December X5, the future repair was expected to be 50. Future, okay. December X6, it was 58. Now it's very simple. We have to make the provision. December X6, you can say closing provision. 1,35,000, 8% of the items need repair and the cost is going to be 58. Calculate 1,35,000, I'll take 8% of that into 58. I'm getting 6,26,400 minus the opening provision. December X5. 1,25,000, 8% into 50. So 1,25,000. They should have given us more information, but they have not given us 5 lakh. So your provision actually will increase by 1,26,400. Your expense will increase. Let's read the requirement options. Farfield company has constructive. Number one, student is not a constructive obligation. Question why it is not a constructive obligation. Farfield company has sold washing machine with a 1 year standard warranty. It's a legal obligation. It's not a constructive obligation. Logically, there's a contract. It's a legal obligation, not constructive. There's no need to read anything else. It's not constructive. It is legal. Farfield company has a legal obligation, should make a provision of 540. We're not getting 540 at all. Farfield has a construct, again, it's not a constructive obligation. Farfield has a legal obligation, should recognize an expense in relation to the provision for warranties 1,26,400. So option D. D is correct. Okay, let's go ahead. Question 12. Fine. What revenue should more company recognize in the year ended December X5? Revenue, IFRS 15. Previously, it was IAS 37. I think they have tested almost every IAS and IFRS. On 1st September X4, more companies sold an item of heavy plant to a customer. They sold a heavy plant, I think, for heavy price as well. $460 is a very heavy price. So it is not only the plant is heavy, I would say price is also heavy. The plant was delivered on the same day. So logically, we fulfilled our performance obligation. The customer paid a deposit of 50,000 on a delivery. On same day, customer they paid how much? 50. But still they did not pay 410. And more company provided the customer with a 2 years interest-free credit on the balance of the cost. Approved. So logically, we are getting 50,000 today. If I'm getting 50 today, so that is itself in its present value terms. But remaining 4,10,000, I have to bring that on present value because I'm getting this 410 in 2 years time. So 1.06, logically, I'm getting this amount after 1 year. So I should be discounting 0.06, the power is minus 2. That gives me 3,64,000. I'm getting 898.5. So with a rounding off, make it 99. 50,000, 3,64,899. I'm getting 4,14,899. This is the value of your revenue. Simply cash debit by 50, receivable debit by 364899, and the revenue will be credited by 414899. Just students, 3 minutes break. There's no need to go anywhere. Azan is sounding right now. Let me pause the video. Unnecessarily, the video becomes long. Okay. Which statement correctly reflects accounting treatment permitted by IAS 20, accounting for government grant and disclosure of government grant assistance? IAS 20. If there's a grant relating to fixed asset, then according to IAS 20, there are two possible accounting treatments. You can follow any one of them. One, the grant can be deducted from the carrying amount of the asset. Second, treat that grant as deferred income. And slowly and gradually, as you depreciate the non-current asset, then through amortization, grant becomes your income. Let's read and identify which accounting treatment they are following, okay? On July X8, Field Farm Company received 90,000 grant from a local government to support its expansion. The grant was used to acquire a tractor costing 240 on 1st August X8. The tractor has a useful life of 10 years. Grant income 90,000 is recognized in the P&L. This is absolutely incorrect, false. It's not a, I would say, revenue nature grant, and you have already met the conditions and recognize that as an income. So you cannot recognize entire 90 in P&L. So one is wrong. Grant income is 4,500 recognized in the P&L. Let's check this. If they are saying grant income 4,500, so basically point number B is giving you the reference to think for a deferred income treatment. Now under deferred income treatment, we will amortize this 90,000 over 10 years. So let's see if the amortization amount comes 4,500. We don't know. 90,000 divided by 10, number one. Number two, you will start amortizing the grant from the same date when you start depreciating the fixed asset. So depreciation of the tractor actually starts from 1st August, not from 1st July. From 1st August till December X8, there are 5 months. Let's see the amortization amount. Are we getting 4,500 or something else? No. Students, amortization amount is not 4,500, it is 3,750. The grant is presented as a liability with a carrying amount 86,250 December exit. Now this is possible. Actually 8750 through amortization becomes your income. 3750 becomes your income through amortization. So the 90,000 minus 3750 will give you 86,250. This is the carrying or liability carrying. Of course, examiner has not split this 8625 into current and non-current, which he could have done, but okay. Let's see other option as well. Right now, I'm considering option C, but there's no harm to check other one also. The tractor is presented as property, plant and equipment. Carrying amount is 144,500. Let's see, which means now this last option is actually giving you the hint of thinking about the accounting treatment where we deduct grant from the cost of the asset. 2,40,000 minus 90 will give us 150. And logically, this 150 we will depreciate over 10 years. And how many months depreciation? 5 months. Let's see, either we are getting D or not. So 150 divided by 10 will give us 15. 5 upon 12, I'm getting 6250. Oh, we were very close. Students, the last one is incorrect. Actually, if I deduct the grant from the cost of property, plant, and equipment, then the carrying amount should have been 1 lakh 43,750, not 144. So I'll consider this MCQ is a very good MCQ. See, I love this one. Seriously. So logically, the answer to question number 12 is it 12? 13 is Charlie. Wow, 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 wow. It's a good question, students. A good question. Let's go for question number 14. What amount should Missile Company report as intangible asset at 31st October X8 in respect of this expenditure? Intangible, I is 38. What amount should Missile Company report as intangible assets at 31st October X8 in respect of this expenditure? In the year ended 31st October X8, Missile Company incurred following expenditure. 3 lakh 30 to buy the right to a soft drink formula on January. The rights were determined to have an indefinite useful life. Indefinite, it means we are not going to amortize it. So number one, obviously 330 definitely will come in the carrying amount of your intangible asset. I cannot amortize. Why? Because the life is indefinite. We know that if you have an intangible asset having indefinite life, then you every year you have to carry out the impairment test. Either there's an indicator of impairment loss or not, but that's a separate story. Leave that. $12,000 to register its legal right to the formula on the day it was acquired. The right has no termination date. So obviously I will capitalize 12,000 also. 45,000 to build up a list of customer and their preferences. The list was completed. On 1st March, X said expected to be useful life. I cannot capitalize this. Sorry. 1,50,000 to acquire technology. Acquire technology on July exit. It was expected to be used by Missile for 10 years. Wow, wow, wow. I'm paying to acquire technology. So obviously it is going to be a part of my intangible asset, but it has a useful life of 10 years. So let me deduct the amortization. How many months I have to amortize? July, August, September, October, 4 months. Let me use the calculator. 1,50,000 divided by 10, 4 upon 12. Actually, amortization answer is 5,000. So logically from 1,50,000 I will deduct 5. So I'll get 145. So 330 plus 12 plus 145 will give you the carrying amount of your intangible assets at 31st October exit. 330 plus 12 plus 145. Students, I'm getting 4,87,000. That is question number 14. Let's go for question 15. Okay. Which statement is correct in relation to financial statement for the year ended December exit? Which statement is correct in relation to the financial statement for the year ended December exit? Okay. On December exit, it's year end. Sadly, company decided to change the assumption used to measure the cost of its inventory from average cost to first in first out. That is change in accounting policy, and change in accounting policy is applied retrospectively. The measurement of the inventory using both method was as follows. Repeat, it's a change in accounting policy, change in accounting. Of course, in the current year, you are following the new accounting policy, but you have to update, restate your comparatives as well. because change in accounting policy is applied retrospectively. Which statement is correct in relation to the financial statement for the year ended December X8? Let's see. First of all, December X6 inventory will be the opening inventory for X7. Okay. And since it's a change in accounting policy, so we have to apply this retrospectively. Of course, in 2008, you will be following the new accounting policy. That is not an issue. The issue is comparatives. Okay. They have given us the value under both the methods, average and first in, first out. Now, student, keep watching it. Opening inventory. Closing of X6 is opening for X7. Average cost, under average cost, opening inventory for X7 is 52,500. This is average cost. Okay. And let's see FIFO. FIFO says 55,000. Now try to understand. If I go for FIFO from the average cost, logically opening inventory of X7 will increase. 52,500, 55,100. Student, opening inventory will increase by 2,600. Opening inventory of comparative will increase by 2,600, but story does not end here. Story does not end here. Let's check the closing inventory. X7 closing inventory under average cost is 50,400. Under FIFO is 52,100. So 50,400 minus 52. This students, there's a rise of 1,700 also. Now please try to understand. If you are changing your accounting policy in 2008, change in accounting policy is applied retrospectively. It will have the impact on comparatives. Okay. Opening inventory will increase by 2,600. Closing inventory will increase by 1,700. So net, there's a net rise of 900 in opening inventory. And let me tell you one thing. If your opening inventory increases, then your cost of sale will also increase. If your closing inventory increases, then cost of sale will reduce. So let's see what happens. The options. Cost of sale of comparative statement of P&L for the year ended December X7 is restated. Oh, wow, 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 wow. I love this examination team. Student, no need to read any other option. Prior period adjustment 2,500. No, 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 no. This is a change in, no, this is not a change in accounting estimate. Come on, it's a change in accounting policy. And a student, option A is your answer. Let's go for section B. So I think we should appreciate the entire examination team, ACC examination team of FR. I think within these 15 questions, they tried their level best to, I think, incorporate, consider almost the entire syllabus. Let's go for section B. That's great. What is the correct carrying amount of inventory in Danya's company's financial statement at 31st December exit. How many decimal? Two decimals. What is the correct carrying amount of inventory? So we have to read. The following scenario relates to questions 16 to 20. D Companies is preparing its financial statement for the year ended 31st December X8, has identified the following issues. Inventory. In the draft financial statement, which are not fully prepared, D Company's closing inventory is 8.6 million. Product A, which cost 0.36 million, was incorrectly included in this balance 0.63. Stop. Inventory. 8.6 million they have given us. They should have recorded 0.36. They should not have recorded 0.63. So what they should have recorded, I'm adding that amount and I'm deducting which they by mistake recorded. So 0.63 should be deducted. 0.4 million. We know that under IAS 2, cost or NRV, whichever is lower. So product B was included at its cost 0.4. However, it could only be sold for 50% of the normal selling price. A very big, I would say, indication that NRV of product B is lower than the cost. So student, all you need is deduct the cost from 8.6 of product B and add NRV. 50% of normal selling price due to technological fault in one of the parts. The company charges markup 30%. Look at this. If I calculate NRV of 0.4, 0.4 is cost. Markup is a percentage of cost. First, let's calculate the selling price of 0.4 million. 0.4 is a cost and we sell at 30% markup. So logically 130 upon 100. This is 130 upon 100. Into students, I'm getting 0.26. So the product B, which has a cost in the inventory 0.4 million, now it has NRV only 0.26. So I'm deducting 0.4. Simply we are replacing cost with NRV. So let's see what is the answer. 8.6 plus 0.36 plus minus 0.63 minus 0.4 and plus 0.26. Students, I am getting 8.19 million. And it is mentioned in the box that answer has to be in million. Two decimal, we are getting in two decimal places. Wow. So far, it looks easy. Let's go for the next question. Which of the following reflects the correct accounting treatment of the factoring of D company's trade receivables in the year ended December X8? Students, there are two possible arrangements when it comes to factoring. One is with recourse factoring, where the bad debt belongs to your company and you cannot de-recognize the receivables. Whatever amount you have taken from the factor company, it is a loan. The second is non-recourse factoring, where you transfer the burden of bad debt to the factor company. Then your receivable, they will be considered as that you have sold the receivable under non-recourse factoring. So let's read. Trade receivables. On 1st November, XAD factored sold 2 million of trade receivables to capital company. Wow. Denia receive an immediate payment of 1.8 under the factoring agreement. Any receivable not collected after 4 months will be sold back to D. No accounting entries have been made. So look at the arrangement. It says any receivable which is not collected by the factor company. You have to any receivable which is not collected by your company, which is not collected by the factor company, you have to refund. Any receivable not collected after 4 months will be sold back to D company. No accounting entries. So simply, this is a scenario of with recourse factoring. Under with recourse factoring, whatever amount you have received from the factor company, technically that is a loan for you. Your receivables are not sold. Let's read. An admin expense 2 lakhs should be recognized. No. It's not a non-recourse factoring. I can't do that. A receivable should be de-recognized from the statement of what is this? What sort of receivable? This represents it's a with recourse. Receipt of 1.8 million should be treated as a loan. D. Cash or bank debit, simply the loan credit. Okay. The measurement of inventory at cost and NRV. Okay, fine. Reflects which of the following qualitative characteristics? It actually shows faithful representation, nothing else. It is simply a faithful representation. Obviously, if NRV is lower, why you are keeping your inventory at cost? What's the carrying amount of equity component of the convertible loan note? Convertible loan note, first you should IS 32 should come in your mind without you mind it. Plus, how do we actually split convertible loan, which is a hybrid instrument, into debt and equity component? We simply first calculate financial liability. We calculate debt component. Debt component is equal to present value of all future cash flows. Once you have calculated the debt component, then from convertible bond, we will deduct the debt component and balancing figure will be equity component. Okay. And for discounting, we take the discount rate without conversion option. D company issued 8%, 30 million convertible loan notes on 31st December X8 at par. Interest is paid annually in arrears on 31st December. An equivalent loan without the conversion option would carry an interest, so 10% will be my discount rate. The loan notes are redeemable, convertible in 5 years' time. So let's first calculate the debt component. How will we calculate debt component? It's very easy. 1, 2, 3, 4, 5. Annual cash flows. Let me just say, I'm just ignoring 3 zeros for the sake of simplicity. Then obviously closest choice we will pick from the options. I'm just writing this 30,000. Cash interest is 8%. Let me take 8% of that. I'm getting 2,400. Student, in the last year, there will be interest plus the principal. So in the last year, I'm writing 32,400. How did I get 32,400? Actually, in the last year, we'll write 2,400, which is the cash interest, and 30,000 is the principal amount. Discount rate, student, will take market interest rate without conversion option, which is 10%. 0.91, 0.8375, 0.75, 0.68 and 0.62. Let's multiply. 2,400 into 0.91, I'm getting 2184. 2,400 into 0.83, I'm getting 1992. 2,400 into 0.75, I'm getting 1,800. Wow. 2,400 to 0.68, students, I'm getting 1,632. 32,400 to 0.62, I'm getting 2,088. Let's add all of them, you will get debt component. 1,632, 1,800, 1,992, 2,184. Student, the debt component I'm getting is 27,696. So how to get the equity component? Equity component is a balancing figure. From 30,000, we will deduct 27,696. And don't forget that we have ignored 3 zeros. Students, I'm getting 2, 3, 0, 4, 0, then 000. Let's see the closest choice. Wow. Closes, that is exactly the same answer. C, Charlie, wow. So this question is also a good question, students. Which of the following statement is incorrect? Wow, I love this. Your examiners, they're not leaving even a single part of, I would say, syllabus. They're trying to test every inch of your course, they don't want to, leave even a single stone unturned. They're turning all the stones. Which of the following statements is incorrect? Incorrect. According to IFRS 18, presentation and disclosure in financial statement, we know that there's no more IAS 1. It is replaced by IFRS 18. Okay. So which statement is incorrect? Entities are permitted to prepare financial statement for a period shorter than 1 year. That is true. Your answer is not, you are not here to find out the true correct statement. Your answer will be which one is incorrect. One is correct. Asset and liabilities should be aggregated based on characteristics that are shared and disaggregated based on characteristics, obviously. If they have got similar characteristics, you can add them. Otherwise, do not add. Okay. Asset and liabilities and income expenses should not be offset unless another IFRS accounting standard allows. That is also true. If it is not allowed, you cannot offset. Presenting trade receivables. Presenting trade receivables net of an allowance for credit losses is an example of offsetting. That is false. Offsetting is something else. Offsetting is when I'm simply offsetting receivable against payable, if it is permitted by IFRS 9. So, but if I'm deducting the credit loss from the receivable, it is not an example of offsetting. So basically the last one is your answer, D. Because examiner is asking here, which one is incorrect? Which one is incorrect? Okay, students, let's discuss next question. What adjustment needs to be made to revenue in respect of commission based sale by Harry company? Commission based sale. Basically, number one, it's a scenario of IFRS 15. The scenario is principal and agent. When you are working as an agent, then all you need is just recognize the revenue according to the commission for which you are entitled, not more than that. Okay, let's read. Revenue Included in Harry's draft revenue is 20 million relating to machines sold to customer on behalf of a number of manufacturers. 18 million is included in Harry's company's draft cost of sale, representing the amount payable to the manufacturers. The difference of 2 million is the commission that manufacturers have agreed that Harry company can retain as commission. So basically, Harry company, they have made a mistake. They should have recognized the revenue of only $2 million instead of recognizing a revenue of 18 and cost of sale of 18. So obviously, their existing accounting is incorrect. They should have recognized only 2 million rather than what they have done. Let's see. Reduce revenue by 20? No, it should be reduced by 18. Why would I increase the revenue? Reduce revenue by 18 and reduce cost of sale by 18. D. So basically, Harry company should be reducing the revenue by 18 and you should be reducing cost of sale by 18. Because you are supposed to recognize the revenue according to the commission, which is just 2 million. Okay. What is the weighted average number of ordinary shares to be used in calculation of Harry company's basic EPS? So we need to calculate weighted average number of ordinary shares. The year end is 30th September. IAS 33. Ordinary shares at 1st October X6, Harry company had 36 million equity shares in issue. On 1st January X5, Harry company made a fully subscribed right issue of 1 new share for every 4 share held at a price of 2.8. The market price of equity shares of Harry immediately before the issue was 3.8. So I think just they have given us one right issue. So let us first calculate theoretical ex-right price. How do we calculate theoretical ex-right price? Simply shares values and total value. Shares, values and total value. Ratio is 1 new for every 4. So number of shares before right is 4 and the right is 1. Share price before right is 3.8 and the right price is 2.8. 4 multiplied by 3.8 gives us 15.2. 2.8. So we can say that 5 shares, they have the total value of 15.2 plus 2.8 is 18. 5 shares total value is 18. So very easily we can calculate value of 1 share, which is theoretical ex-right price. Theoretical ex-right price means share price after the right issue. TERP 18 upon 5. 3.6. TRB is 3.6. Now we can calculate simply adjustment factor. An adjustment factor is applicable on all those shares which are there in the question before the right shares. Adjustment factor. How do we calculate adjustment factor? Simply the share price before right divided by theoretical ex-right price. Theoretical ex-right price means share price after right issue. So the share price right before right is 3.8 and the share price after right is 3.6. This is your adjustment factor and it is applicable only on those shares which are there in the question before the right. We have got 36 million shares. And look at the choices. Examiner has not asked examiner is asking us calculate weighted average number of ordinary shares, and examiner has not mentioned in the option ignore 3 zeros million, so we have to consider all the values. So you have to be careful regarding this as well. So the number of shares before right there 36 million. Fraction 3.8 upon 3.6. And how many months? Let's see. Year end is what is the year end? Year end is 30 September X7. 1st October X6. Company was having 36 million shares 1st January. Company has made right issue. Company made the right issue on 1st January. Okay. Oh, just a minute. Simply, if you count the time period, October, November, December, 3 months. Because after 3 months, company has made the right issue. So first 3 months. Okay. Then number of shares after right issue, how will you calculate? 3.36 million. Right issue is 1 upon 4. So let me just add number of rights. 1 upon 4 will give me right shares. So the right shares are 9 million. After right, I'll get 45 million. 45 million. Just a minute. After right issue, we'll get 45 million. And after right issue, there is no further issue. So 9 months. So 3.6 or 36 million multiplied by 3.8 divided by 3.6, 3 upon 12. I'm actually getting 9.5 million. 45 million. I'm getting 33.75 million. Excuse me. Simply add all of them. You will get weighted average shares. So 43.25 million. So 4320. 43250,000. Weighted average number of ordinary shares I is 33. Okay. Question 23. Which four of the following should be the core content of Harry Company's sustainability report accounting for IFRS S1 general requirement for disclosure system? Student, if you recall S1, we have taken classes on S1. There are 4 main core contents. One is, of course, governance. Then we have got strategy, metrics, targets, and the risk management. So let's find. It's 1456. 1456. D. So whoever has attended, I believe, and seen the class on S1, IFRS S1 can easily tackle this question. What are the common fundamental characteristics of useful information? Which information useful? Included in both IFRS sustainability disclosure standard and IFRS accounting standards. Fundamental characteristics, useful information. Relevance and faithful. This is fundamental use, I would say, useful information. So fundamental characteristics are relevance and faithful representation. Okay. How should the change in depreciation method, actually change in depreciation method is change in estimate. A change in accounting estimate and with prospective adjustment. Change in depreciation method is change in estimate, but from in IAS 16 from cost model, if you go to revaluation model, or from revaluation model you are coming to cost model, that is change in accounting policy. Change in accounting policy is applied retrospectively, but change in accounting estimate is applied prospectively. Logically, whatever is the depreciation method, according to IAS 16, your depreciation method should reflect the pattern of economic benefits which you are getting from the asset. If the pattern of economic benefit which you are getting from the asset, if it changes, then you have to change depreciation method. So simply change in depreciation method is change in estimates. Let's go. So let's see another question. Logically, this is the last question of section B. After that, obviously, we do have section C as well. Which statement is correct regarding accrued expenses? Whatever is the expense debit, accrued credit. Okay. Accrued expenses. The statement of financial position includes an accrual for expenses. Carrying amount is 2560. Carrying amount of accrual is 2560. The expenses were deducted from profits in calculating the current tax charge for the year ended 30th June X6. Student, now try to understand. Accounting treatment is expense debit, accrual credit. Then your examiner says the expenses were deducted from profits in calculating current tax charge for the year ended 30th June X6. So basically, we have deducted accrued expense from the accounting profit, and it is also deducted for tax purposes. Simply, the accounting treatment and tax treatment is same. Whenever the accounting treatment and tax treatment is same, then carrying amount and tax base will be same, and there will be no difference, there will be no temporary difference. So logically, if you read it nicely, here the accounting and taxation treatment is same. Whenever the treatment of accounts and tax is same, so you will have the carrying amount and tax base, both will be equal, and there will be no taxable difference, there will be no deductible difference. Simply, there will be no temporary difference, so no deferred taxation at all. Let's read. The accrued expense have a tax base? No, nil, no, not. Accrued expense give rise to a deductible difference? No. Here it is not the case. The accrued expense have a tax base 2560 and there is no temporary difference. Charlie. Tax base is 2560 and the carrying amount is also same. Logically, there is no temporary difference at all. So the answer is Charlie. Wow. What is the deferred tax? IAS obviously 12. Deferred tax to profit and loss in relation to property, plant and equipment. Read the requirement nicely. What is deferred tax charge to P&L, to profit and loss? Nowhere else. Only how much deferred tax you will charge to P&L. Regarding property, plant and equipment. Property, plant and equipment in draft statement of financial position. Property, plant and equipment has a carrying amount 1,96,500. Property, plant and equipment, the carrying amount is 1,96,500. Let's see the tax base. its tax its tax base has been calculated 1 lakh 52,300. Logically, in case of assets, if your carrying amount is more than the tax base, then difference will be a taxable difference. And taxable difference multiplied by tax rate gives you a deferred tax liability. 1,96,500 minus 1,52,300. I'm getting 44,200. Tax rate at the end, they have given us 20%. This will give us you the closing deferred tax liability. 8,840 closing deferred tax liability. Logically, if we have, then I'll deduct opening deferred tax liability. Then you will get deferred tax expense, which examiner has asked us. Deferred tax expense. In the draft statement of financial position, property, plant and equipment has a carrying amount 1,96,500. Its tax base has been calculated 1,52,300. The taxable temporary differences related to property, plant and equipment on July X5 start of there 30,120. So logically 30,120 multiplied by 20% will give us opening deferred tax liability. Examiner has given us opening taxable temporary differences multiplied by tax rate will give us opening deferred tax liability. 6,024. So logically the deferred tax charge which we'll take to the P&L is 2816. Let's read more what is written. Hickson Company Management has decided to adopt the revaluation model for the property with effect from 1st July X6. Estimate that fair value of the property is 85,000 in excess of its carrying amount. 85,000 is logically is going to be your revaluation surplus, number one. Number two, due to revaluation surplus, there will be a taxable temporary difference and that will create a deferred tax liability. But when the deferred tax liability arises from revaluation surplus, then it is charged to OCI. Logically, the deferred tax liability which arises from revaluation surplus, the double entry is revaluation slash OCI debit, deferred tax liability credit. Write down the question being asked is how much deferred tax expense you will charge to P&L. So the answer is 2816. Do we have options? We don't have options. So just write 2816. Which statement best reflects the accounting treatment that Hickson Company must apply when it adopts revaluation model, assuming that fair value of the property, plant and equipment is excess than carrying amount? The initial revaluation surplus is recognized in OCI and give rise to a related deferred tax. No, why would income? No. We have just decided that due to revaluation surplus, logically there will be a taxable temporary difference, and due to that taxable temporary difference, there will be a deferred tax liability, and that deferred tax liability will charge to revaluation surplus, will charge to OCI. The revaluation surplus gives rise to a taxable temporary difference, yes, and related deferred tax is recognized. Perfect. Just perfect. No need to read any other option at all. At all. Okay. Any question? One student has joined late. Yes, this session will still be useful. Don't worry at all, even though you will be attempting the paper in March. No issue at all. And those they are my enrolled students, you will be getting these sessions. They will be uploaded on the portal as well. Don't worry at all. Question 29. Which of the following which of the following correctly describes the initial measurement of a lease liability at 30th June X6? Let's see the arrangement. Lease arrangement. On 30th June X6, Hexon company acquired the use of a machine by way of lease agreement. Lease arrangement. The lease term is 10 years. However, the Hexon terminate the arrangement. Can terminate the arrangement after 6 years on a payment of a penalty, and it is expected to do so. Wow, wow, wow. Lease term is 10 years, but you can terminate the lease after 6 years, and they are saying by paying the penalty, and they are saying Hexon is going to do that. Student, in that case, till 6 year, whatever lease rental, fixed rental you will be paying, I'll take that, but I will take the penalty amount as well. Fixed lease payment will be made annually in arrears. Hexon will also agree to make the additional variable lease payment each year related to the usage of the machine. Hexon company incurred 1250 to have a machine installed and 750 legal fee. Let's read. At the present value of fixed and variable, no. What about the penalty amount? At the present value of fixed lease payment, the termination penalty, why installation cost? Actually, installation cost you will be adding to your right of use asset. Installation cost will increase the carrying amount of right of use asset. It will installation cost is not a part of lease liability. At the present value of fixed variable payment, installation cost, come on. At present value of fixed lease payment, so the last one is the logical. So out of these four options, the last one makes sense. Okay. What revenue should Hexon company have recognized in the year ended 30th June X6 in respect of sale contract? Again, you should think IFRS. By reading this, IFRS 15, revenue from contracts with customers should come in your mind. Sales contract. On 1st March X6, Hexon company sold 1000 identical items to a customer for a total of $12,000. How many identical items? 1000. Offering 6 months credit. Okay. We are just being we are being asked what revenue they have actually recognized. Hexon company agreed to hold the goods for the customer until required. So on the it's a basically it's a scenario of bill and hold. So Hexon, they are holding this on the request of the customer for up to a year. As the customer has no storage facility, Hexon company holds the goods in the separate area of its storeroom. They are identified as belonging to the customer and available for delivery. Means Hexon cannot sell this to any other customer. They cannot use it. By 30 June X6, Hexon has transferred 100 units. Hexon have recorded revenue how much? Based on that 4 months and agreed 1 year holding period have lapsed. So simply when you are holding the goods sold on the request of customer plus they are identified, they are identifiable, you cannot use it, you cannot sell it anywhere else. So simply you will recognize the entire revenue, which is the case here. 1000 identical items they were sold to a customer for $12,000. So what revenue Hexon company have recognized? So definitely they have recognized $12,000, nothing else. Let me correct this. So student, that is section, I would say B. We have already discussed A, then B. Let's go for the last section, which is section C. Student, first I'll be explaining you I would say the entire question on OneNote. Then we'll go to the spreadsheet and I'll show you how to show the presentation, working and solve on the spreadsheet. But let me first explain all the adjustments on the OneNote, that because I believe in this way I can bring more clarity. It's a 20 marks question. Prepare the consolidated statement of financial position of Panama at 30th June X7. So something you can say new. That entire SOFP they are asking. Year end is June X7. Panama company operates in the manufacturing sector. On 1st March X7 acquired 75% interest in a supplier, Trilby, in exchange for 200,000 cash and one of its own shares for every 4 shares acquired in Trilby. So parent, for acquiring the subsidiary, they have given cash and they have also issued shares. The statement of financial position of the two companies at 30th June X7 were as follows. If you just look at the date of acquisition is 1st March. From 1st March till 30th June, if you count the time period, so I've got March, April, May, June, 4 months. Logically, the post-acquisition period is 4 months. Parent's holding is 75%. Let me just show you here. First, I'm just explaining all the adjustment on OneNote. Then don't worry, I'll show you the complete presentation, everything on the spreadsheet as well. Working one, group structure. So parent company is, what is the name? Panama. Panama Co. And they have got 75% holding in, I believe, Trilby. Holding 75% in Trilby Co. Subsidiary. Parents holding is 75, so obviously NCI holding is 25. Post acquisition period is 4 months. So I strongly believe that working one should not disturb you. If you recall the working two, in working two, what do? We show the net assets of subsidiary. Working two. Net assets of Trilby Co, which is our subsidiary. 3 columns at reporting date, at acquisition, then post acquisition. Okay, fine. Let's come here. We know that net asset, they are equal to equity. Trilby, I can see share capital is 80. There's no share premium. So at there we have ignored 3 zeros. So at least I can write share capital. We do not have any share premium in the question. Then of course, retained earnings. If you look at SOFP, they have given us a retained earning 371. But right now we don't know what is the retained earning at acquisition. Okay, fine. Now let's read more information. Panama Company has recorded its investment trail by company at the amount of cash consideration and has made no entries for the share consideration. Stop. Parent, they have just recognized investment in the subsidiary equal to the cash which parent has paid. Parent did not recognize the share which parent has issued. So we have to recognize the double entry of recognizing the shares issue will be investment in subsidiary debit. With the par value, we will credit the share capital, and any amount which is over and above the par value, we will credit the share premium of parent. At acquisition date, market value of Panama Company share was 10. So let me just show you for your understanding. Just come here. Debit and credit. I just want to show you what investment debit. Investment at Trill Company, Trill by company will be debit. We have acquired 75% ordinary shares in Trill by. Ordinary share capital is 80. Do we have any information of the par value? Yes. Market value of Trill by company share was 5.9 and the par value for both the companies is $1. Par value for both the companies is $1. Now come here. 80 million. Of course, 80 million is the share capital divided by par value gives us issued shares 80 million. Logically, we have acquired 75%. Logically, I'm not multiplying 75 with the share capital. I'm multiplying 75 with the issued shares of my subsidiary. Ordinary share capital divided by par value gives us issued shares. Here it is not making any difference because the par value is 1. But logically, we are multiplying 75% with issued shares of subsidiary. The ratio is 1 upon 4. Market value of the parent is 10. Let me use the calculator. So, students, I am getting 150. With the par value, share capital of parent will be credited and with the over and above share premium will be credited. Again, there is no need to make these double entries. You can do it directly. Just for your explanation to make it more clarity, I'm doing this. Let us see how many shares parent has actually issued. Parent acquired 75% of this, 1 upon 4. We are getting 15 million. Logically, parent has issued 15 million shares. Par value of the parent is 1. And when parent issued 15 million shares to the subsidiary, at acquisition, market value of the parent was 10. So with 1, I'll recognize the share capital and with 9, I'll recognize the share premium. Share capital will be credited by 15 and the share premium will be credited by 135. When we'll be preparing consolidated SOFP, then parent's share capital will increase by 15 and parent's share premium will increase by 135. Okay. At first, March X7, Trill by company. Property had a fair value 36,000 in excess of the carrying amount. Don't forget we are ignoring 3 zeros. So straightforward 36,036 is the fair value adjustment. The property has a remaining life of 20 years. Two things. One, we have to take this fair value adjustment, and second, there will be additional depreciation of 4 months also. And the life they have given 20. Fair value adjustment. Fair value adjustment building. 36. additional depreciation on fair value adjustment. 36 divided by 20 will give us the depreciation for the entire year, but the post acquisition period is only 4 months. So let me use the calculator. 36 divided by 20 gives me 1.8, then 4 upon 12 gives me 0.6. 0.6 will be deducted from the net asset at reporting date, not at acquisition. Okay. We have done with one more thing. Point number 2. Panama has elected to measure the non-controlling interest in Trilby as proportion of net asset, means partial goodwill. But this is something interesting. Why? Normally, if you look at the past paper, whenever normally examiner gives you the market share price of the subsidiary, normally examiner keeps NCI at fair value. But here it is categorically mentioned. They will be keeping NCI as a proportion of net asset. It means partial goodwill. Okay, we have no problem at all with this. In the year ended 30th June X7, Trailback Company made a profit of 33,000, which accrued evenly across the year. Now stop. We have acquired the subsidiary during the year. Okay. Logically, the post acquisition period is only 4 months. Examiner has given us the closing retained earning of our subsidiary, which is 371. 371 is the closing retained earning of my subsidiary. And we have acquired the subsidiary during the post acquisition period is only 4 months. And the question says, in entire 12 months, your subsidiary has generated 33,000 profit, and which is accrued evenly over there. So from it means entire 33,000 impact is included within this 371, which is the closing retained earning. If we deduct just post acquisition months profit impact from 371, that will give us the retained earning at acquisition, because we have acquired the subsidy during there. So 33, which is the profit for the entire 12 months, post acquisition period is only 4 months. 4 upon 12, if I deduct the profit which came in the post acquisition period, then I can easily get the retained earning at acquisition. So profit which came in the post acquisition period is 11. If I deduct 11 from 371, I'll get 360. So come here. Now we can calculate retained earnings at acquisition. So logically 371, 4 upon 12, 11, 360. So post acquisition profit is 11 million. Okay. In the year ended, just a minute. In the year ended 30th June X7, Trailback Company made a profit of 33,000, which accrued evenly across the year. This was considered considerably lower than in the previous year. Panama Company directors were aware that Trailback Company was struggling to control cost prior to the acquisition date. They had already decided to restructure. Whenever the term restructure comes, you should be thinking for IAS 37. Trailback Company's business to eliminate a layer of management. So that is restructuring. This would incur expected redundancy cost 60,000. The restructuring plans were announced to Trailback Company's staff member when 20 March X7. When did we acquire the company? We acquired on 1st March X7. So basically, we are not announcing the day we have acquired. We are announcing on 20th March. The restructuring will commence in July X7. And your restructuring will commence, but it will commence in July X7. and it will be completed by December X7. The intended restructuring costs are not reflected in either company's financial statements. Now, this is very important. They did not recognize that restructuring provision at all. But first, please try to understand. Logically, this restructuring provision is not coming the day we are acquiring the subsidiary. We have acquired the subsidiary on 1st March. But under restructuring, the recognition criteria is not met on 1st March. Basically, under IS 37, restructuring provision will only be recognized when there's a formal, detailed plan for the restructuring approved by BOD and public announcement. If you read the question nicely, so we can say that at acquisition we can't see any announcement. Announcement came, but it came on 20th March X7. The restructuring will commence in July X7. Very soon it will commence as well. It will be completed as well. So basically, we will be recognizing the provision, but logically we are not supposed to recognize the provision at acquisition. This provision will be recognized at the reporting date, which means that provision reporting date. Why we are taking it here 60? Because one, at acquisition recognition criteria of restructuring is not met. Second, at the year end criteria is met, but examiner did not recognize the provision for restructuring. So we are doing it. Okay. Next, throughout the year ended June X7, Panama company has bought 8,000 goods from Trail by company per month. Trail by makes a profit 25%. So subsidiary is the seller, but the post acquisition period is only 4 months. At 30th June X7, Panama company still held all of the goods bought in May and June X7. It is still owed Trail by company all the goods bought in June. Now try to understand. Number one, we will eliminate unrealized profit on intra-group trading of goods only on that inventory, which actually subsidiary has sold in the post-acquisition period. Number one. Number two, which is unsold, which is there in the group, which is unsold. So post-acquisition period is 4 months, but unsold inventory belongs to only last 2 months. Number two, seller is subsidiary. So that is why unrealized profit on a stock will be deducted from the net asset at reporting date. If seller were parent, then whatever the unrealized profit comes, we deduct from the retained earning, group retained earning. Right now, subsidiary is the seller, so unrealized profit will be deducted, will be eliminated, number one, and will be deducted from the net asset at reporting date. So only 2 months stock is unsold. So 8,000 is per month. We have to ignore 3 zeros into 2. So the 2 months sale is still, you can say 2 months stock is still unsold by Panama company. Subsidy, how much markup they charge? 25%. Markup is a percentage of cost. It means the selling price is 125%. And I just need to find out element of unrealized profit. I'm getting 3.2. Unrealized profit on inventory. 8 into 2, 2 months, 25 upon 125, 3.2. Okay, what else? 1 month, question says still owed till by a company all goods bought in June. Just 1 month payable and receivable is there. If there is any intra-group balances between parent and subsidiary, according on the basis of substance, group means one entity. So you will have to eliminate payable and receivable between parent and subsidiary. If there is any payable and receivable between parent and associate, you cannot eliminate, because on the basis of substance, parent and associate, they are not one entity. But when it comes to parent and subsidiary, if there are any intra-group balances, I have to eliminate. So only 1 month is due. So receivable will be credited by 8 and the payable will be debited by 8, because per month sale amount is 8. Panama company acquired its investment property on 1st January X7, so that only belongs to Panama. It has nothing to do with the subsidy. Just a minute. No, that's a different question. No more adjustments. So here comes net assets at reporting date, acquisition. Let's see. 80 plus 371 plus 36 minus 0.6 minus 60 minus 3.2. Students, I'm getting 423.2. 80 plus 36 plus 80 plus 360 plus 36. I'm getting 476. 11 minus this minus this. I'm getting 51.6 negative. Now let's calculate goodwill working through. Let's calculate goodwill working 3. Cost of investment. Let's ignore 3 zeros. Cash, shares issued, market value. It is mentioned in the question that parent has recorded the investment in subsidiary at the value of cash which they have paid. So let's see. Investment in Trilby is 200, which is cash consideration. Cost of investment cash is 280 million into 75%, 1 upon 4. Market value of parent share is 10. That gives us 150. So it becomes 350. Let's take NCI also. And it is mentioned in the question that group keeps NCI at proportion of net asset. It means partial goodwill. NCI at acquisition. We'll take net assets of subsidiary at acquisition 476 from working to into 25%. 476, 25%, I'm getting 119. 469. Now simply less net assets at acquisition. Again, we have to give the reference of working to. Less net assets at acquisition. Working to 476. Wow. I'm getting a negative goodwill. The negative goodwill is 7, which is gain on bargain purchase. An entire gain on bargain purchase belongs to parent. It will increase group's retained earning, no matter it is a partial goodwill method or a full goodwill method. Whatever the gain on bargain purchase comes, that actually belongs to parent, because parent is the one who has got the control on subsidiary. Gain on bargain purchase, negative goodwill, basically just goodwill slash gain on bargain purchase. Okay. Working for, let's quickly calculate NCI, non-controlling interest. NCI at acquisition, we can take it from working 3. We are ignoring 3 zeros, 119. Then simply add share in post reserves working 2. Interestingly, this time in the post acquisition, we don't have positive balance, we have got a negative balance. It is 51.6 negative. This will actually reduce your NCI value. 51.6, I'll take 25% of this. I'm getting 12.9. Let me just check. Just a minute. Come here, please. Let me just check this. Students, that is actually 52.8. It's not 51.6. That's my bad. Let's do the correction. It's negative. So it is actually negative 52.8. Okay. We'll take 25% of this. 13.2. So 119 and 13.2. I'm getting NCI 105.8. Now let's calculate working 5, which is group retained earning. First, we'll be writing the retained earning of parents. Parents retain earnings. Then we'll add share and post reserves. Again, we'll give the reference of working 2. This time again, we do not have positive reserves. We have got negative. 75% of that, which is 39.6. If you recall, gain on bargain purchase coming from working 3 belongs to parent. That will increase the retained earning. Gain on bargain purchase. I'll give the reference of working 3, which is 7. Then let's check what is the amount of retained earning of parents. Student parents retained earning amount is 518. Parents retained earning amount is parents retained earning amount is 518. Let's see the last adjustment which we did not see. Look at the last adjustment. Panama company acquired its investment property on January 7. The property cost 1,44,000, had useful life 50 years when it was acquired. The Panama company directors have decided to adopt the fair value model for investment property. We know that under fair value model, IAS 40 investment property under fair value model, we do not depreciate. IAS 40 investment property under fair value model, we do not depreciate investment property, number 1. Number 2, whatever the change comes in the fair value, that goes to P&L, means it will impact the retained earning. Panama company directors decided to adopt fair value model for investment property and have been advised that fair value is 170. Other than recognizing the property at cost, no accounting. So they did not recognize the gain on investment property, which is 144 minus 170, 26. So that will actually increase the Group's retained earning. So fair value gain on investment property. Fair value gain on investment property. Simply 170 minus 144. Just a minute. $26. We do not have any other adjustments. Let me use the calculator. 518 minus 36.6 plus 7 plus 26. Students, retained earning amount I'm getting 511.4. So students, we have discussed all the adjustments. Okay, we can do one thing. I'm quickly preparing consolidated SOFP on the spreadsheet. Even though after doing all these adjustments, you can easily easily prepare consolidated SOFP, but it's okay. But obviously, when you will be solving, so first, how to solve this on the spreadsheet? Let me explain that. Logically, first you should make the format of SOFP. After making the format of SOFP, then you go for the workings. So it's a good approach. There's another approach is also possible. First, do all the workings on the spreadsheet, then go for the presentation. But if you ask me, if I were solving, so I would have first made a format of SOFP and then I'll go for the adjustments. That looks a little bit better. So obviously when you will be solving, so I would recommend first make the format of SOFP and then do the adjustments on the spreadsheet. When you will be doing adjustment on the spreadsheet, students, while solving the question, while preparing consolidated SOFP, you have to properly give the reference of the workings. Plus, if it is possible, then create the link as well. So reference of the working is must. Then in addition to that, if you are able to create the link, then you should create the link as well. But most important is reference of the working. Let us go towards the spreadsheet. Let me pause the video, otherwise unnecessarily video will become very long. Let me just pause the recording. Okay, students, we are actually dealing with question 31. Simply consolidated SOFP. Consolidated statement of financial position. Name of the parent is Pana. Consolidated statement of financial position of Panama Company at the date is 30th June X6. What is wrong with that? 30th June X6. So Panama. We are ignoring 3 zeros. Okay. Let me take it here. First, obviously, non-current assets. Under non-current asset, if you see the question, first we'll be dealing with the property, plant, and equipment. Property, plant, and equipment. Students, Panama Company is having a value of 480. Trilby is having 457. Let me show you the workings here. 480 plus 457 plus a student. Now we have to take the fair value adjustment. We took the fair value adjustment in working 2. Okay. As I mentioned to you that giving the reference is necessary. If possible, create the link, otherwise it's okay. So fair value adjustment is working 2. 36 minus additional depreciation. If you see additional depreciation, student, I have calculated 0.6. So I will minus 0.6. Again, let me give the reference of working 2. Close the bracket. Of course, it does not serve the purpose. Now, here I can easily calculate the value which we need. It is 480. Oh no, what happened? Something went wrong. 480 plus 457 plus 36 minus 0.6. That's it. Student, property, plant and equipment value is coming 972.4. And of course, when examiner is whoever is going to check this, they will select this cell. It will give them the reference. Plus, when they will see, they will collect this property, plant and equipment. So that also tell them the entire story. Okay. After that, there's investment property. Investment property value is now 170. Investment property. Actually, it is 144 plus you can say 26. No need to give any reference. Directly, I can write 170. We do not have any goodwill because in this question, gain on bargain came. So the total non-current assets, 972.4 plus 170. Now we'll go for obviously current assets. Student, if you recall, I did mention many times in my regular classes also, that is IFRS 18. So you have to follow the format. First, you'll be writing inventory, then receivable, and then cash. Inventory, receivable, cash. Otherwise, you can copy from the question. Examiner has written inventory, receivable, and cash. Let's write inventories. Inventories. Parent is having 63. Subsidiary 42. Now, students, we will deduct unrealized profit. Unrealized profit is 3.2, which is coming, which you can see in the working 2 if I'm not wrong. 3.2 working 2. Now let's come here. 63 plus 42 minus 3.2. Inventories, receivable. Student, it was mentioned at the end, the second last transaction, that only 1 month payable and receivable is left within the group. So within parent and subsidiary, if there is any receivable and payable, that will be eliminated. Payable will be debited by 8 and the receivable will be credited by 8. So receivable, receivables, again let me show the examiner. I'm getting 41 parent. Subsidiary is having how much? 24 minus 8, which is okay, which is intra-group. So 41 plus 24 minus 8. So I've given the reference what I'm doing with the 8. Cash, we have only cash with the parent, so cash is 10. So let's see the total of the current assets. So total of current asset is 168.8. Now we can calculate total asset very easily. Total assets plus this. Student, I'm getting total assets. They are in front of you. 1311.2. Now let's go for equity and liabilities. Equity and liabilities. Share capital only parent, share premium only parent. Share capital. Now let me show you that also. Parent share capital, you can see that in the question it is 100. Then if you recall the adjustment which I have explained you, parent has issued 15 million shares to acquire the subsidiary. Okay. And parent did not recognize that transaction, but we, while doing the working, we have recognized that transaction. So parent's share capital is 100 plus share capital of parent will increase by 15. And you have to give the reference, which I did not give the reference. Let's make that, you can give any reference, which I did not give it. So please do give the reference. Otherwise, let me show you something else, what we can do. Let me try something else. Subsidy shares, there were 80 million. Parent took 0.75. Parent issued 1 against 4. Par value of parent is 1. It is serving the purpose also. Now I'm not giving any working reference because I did not do any working. I did it directly in the cell. You can do that also. Otherwise, it's better to give the proper working reference. Share premium, again, share premium will be only parent share premium. You have to show. Share premium in the question. I can see parent share premium is 35. Then if you recall the double entry, we credited share premium of parent with 135. Now let me do something here. 35 plus 80 million into 0.75. Then parent issued 1 share against 4. Multiply by 9. Parent's market value of the share at acquisition is 10. 1 is par value, 9 is share premium. So the share premium total of parent I'm getting is 170. Retained earnings we have calculated. You have to give the reference of the working. I think it was working 5. Just a minute. Oh no. It's very delicate. Something, just a minute. Retain earning is working 5, yes. And the total is 511.4. Retain earning, working reference is 5. Student, you have to do the workings, everything on the spreadsheet, okay? Just to save the time I'm doing this, otherwise the video will be very long. And students nowadays, they don't have that much time. It is 511.4. Let me write the total of the equity. Logically, it is parent's equity. Logically, it's parent's equity. NCI, working number 4, non-controlling interest. Working 4, value is 105.6. 105.8. Now we can calculate the total equity by adding logically parent's equity plus NCI. So 902.2 is the total equity. Let's go for the liability section. Liabilities. Okay. Interestingly, we do not have any non-current liabilities in the question. Generally, we do have. Normally, we do have, but this is not the case here. So we'll take current liabilities of both the organization. Then we will simply deduct intra-group 8, and then we'll add provision 60 because the provision for restructuring they did not recognize. So let's come here. We have got current liabilities only. What about the we have got non-current liabilities also, 180 and 40. My bad. We have got non-current liabilities because the size of the font size of the question is very small. That is why I missed. Non-current liabilities, parent is having 180 and subsidiary is having 40. Okay, no issue at all. Non-current liabilities. I'm getting 180 plus 40. Now let's go for the current liability. Current liabilities. 105 is parent, subsidiary is 32, minus 8 intra group. Minus 8 and plus 60 provision. Now come here. 105 plus 32 minus 8 plus 60. Now let's calculate total of equity and liabilities. So total equity and liabilities. So student, you can see that, thank God it is balanced. So you can see that it is completely balanced. Now, let's go to the next question. And next question, we'll be doing it very quickly. Okay, students, since the video is getting very, very long, let me quickly explain in this question what is actually happening. They have given you 4 marks for calculating the ratios, and there are 16 marks on analyzing and commenting on financial performance and the position of correct company for the year ended December X6. I'm just giving you the overall idea. Number one, for calculating equivalent ratios, they have given you the ratios which you need to calculate. You need to calculate operating gross profit margin, operating profit, return on equity, net assets, turnover, gearing. You'll be using the formula debt upon equity, trade payable period, receivable collection period, inventory holding period. Okay, now calculation of these ratios is straightforward. You will be getting just 4 marks. The main thing is comments. Analyzing and comment on the financial performance. Basically, I'm just giving you the overview of this question so that video should not be very long. Basically, what is happening in this scenario? Whatever industry they are dealing in this industry, basically what happens, recession has come. And due to recession, of course, the performance of this business is not good at all, number one. You will see impairment loss in the question. You will also see redundancies, of course. Due to redundancies, your cost will increase, plus impairment loss. Now, performance overall of performance of this business is not good as compared to the previous year, because number one, because of the recession. Number two, you will be actually analyzing it like, let's say you have calculated ratios and you have decided that performance is not good, but then you will have to also tell your examiner that impairment is not something which is going to come every year. A redundancy cost is not something which we'll be bearing every year. So it means you can say these are the non-recurring items. These are the non-recurring events. Others event you may find also. So if we exclude non-recurring events, and then if we see the performance, then there's a possibility that performance does not look that bad, which we can see after due to inclusion of those events. They are one off, they are not recurring nature events. So if we obviously, if I exclude the impairment loss, if I exclude the impact of redundancy cost and other XYZ non-recurring events, then definitely the performance of the business will look I would say better than what you will see while you will be solving this question. Now, what is the problem in that question? When you will be writing in the exam that performance is not good as compared to the previous year, in the entire question, we cannot directly make the decision that their performance is good or bad. Why? Because we are just comparing with the previous year of our own business. Examiner has not given us the information of the competitors. See, if examiner gives us the information of the competitor as well, then it will become more interesting. Then we will be in a position to see that how we have performed under recession and how competitors they have performed. For example, the performance of competitor and the our performance, more or less it is same. So it means then we are not bad at all. But the one thing which is missing is competitors information is missing. While answering this question, you should be highlighting that as well. That it would have been better if competitors information was given. So that would give us an idea that how competitors they have performed. So just you need to calculate ratios, equivalent ratios, which I've just shown you, and then comments. For writing the comments, students, let me tell you one thing. First, just write simple 1.5 to 2 lines on each ratios. The volume which examiner produces, nobody is expecting the same volume and nobody is expecting the same quality from you. Because while sitting in exam, the same volume becomes very difficult to produce. The same quality becomes difficult to produce, but the major chunk of your answer and the examiner should be same. At least the direction should be same. If you are deciding after calculating the ratios that performance is not good, so examiner should also say the same thing. Plus, as I mentioned, that you should also be mentioning this point. There are number of events, they are non-recurring. If we exclude the impact of those, if we do not consider non-recurring events, then performance is better than what we can see right now. So students, take it as a homework. You will be calculating ratios, and then part B, you have to analyze and comment. In the entire question 32, if you have any problem in any ratio, if you are unable to understand any interpretation of your examiner, I am available. You can just highlight the paragraph which is not understandable by you. I will explain you. And you have to write in your own wordings. Nobody is expecting and asking you to write jargons and the technical terms. So students, just so that video should not become very long, I think we started at 12 and right now it is 3:30. So students, that is all about ACCA pre-scene mock December 25 FR from Abil School of Accountancy and from Abil Ahmed. Tomorrow, inshallah, we are going to discuss ACCA pre-scene mock taxation December 25. So tomorrow, Same timings, we'll be discussing pre-scene December 25 pre-scene mock of taxation. So thank you very much that you people have taken out time for attending the live pre-scene ACCA FR mock December 25. If you have any queries, you are more than welcome to ask in your relevant WhatsApp group. Videos, the entire pre-scene will be uploaded on your portal. So thank you very much.